Okay, thank you. If I've been unmuted there, I'll just check and see. Yes, my apologies for being late. I set my time zone wrongly. I chose the Moscow.
Yeah, we can hear you very well. It's all okay.
I'm very, very late, but I'll do what I can in the meantime. Just give me a moment to change what I'm seeing on the screen here so that I can actually start my presentation button. And I'll just have to change one more setting here as well. So, are you now seeing my title there? The title of my talk? The Inherent Complexity of Macroeconomics. You are seeing it? Good. I presume that's the case. Okay.
Yes, we can.
Okay.
We can see it all very well. It all changes. It's fantastic.
Well, and that's Philip Anderson's beautiful destruction of the idea that you can create a higher level science from a lower level science. So in this beautiful paper, More is Different, Philip Anderson argued that you can actually rank the sciences in this fashion of saying that, a solid state physics depends upon elementary, chemistry depends upon many body physics, et cetera, and say, you can, science X depends upon Y, or science, and therefore but that doesn't mean that you can derive science X from science Y. In other words, reductionism is a useful tactic for scientists to understand a complex issue to some degree. There are limitations, but that doesn't at all imply you can start from a lower level and derive the higher one. And that's what economists have been doing for decades now. They've been trying to, the Globe and Cycling English Channel, okay, the bottom right, I'm looking for that at the moment. Do I have to do that now? I'm not sure.
It is best that you do it now.
So should I stop and do that? Globe and English Channel. I'll stop screen sharing quickly, and then I'll see if I can see that
you will need that. You will need that to answer questions.
Yes, okay, interpretation, English. Okay, I've done that. Thank you.
Interpreter speaking, can you hear me?
So now you can hear the interpreting. If the questions are asked, we will interpret and you will hear the interpretation.
Yeah, okay, that's
much.
Great. Okay, thanks. I've done that now. Okay, I'll go back to sharing my screen. Thank you. All right, so back to this one and share. And then right now, you should be seeing my presentation once more. So economists have been trying to do what Philip Anderson pointed out, I think over 50 years ago, was impossible, to derive a higher level science with macroeconomics from a lower level of micro. So the whole process, the last 40 years of economics has been futile. And the foundations themselves are fiction. When you take a look at the actual empirical data, the rising marginal cost does not apply to advanced manufacturing industries, and that's most of GDP. You can't derive a demand curve from individual demand curve, et cetera, et cetera. So it's a waste of time. Now that doesn't mean there are no foundations, because this is what the neoclassicals themselves think. That's all they've ever done. They haven't thought there's any way to reason otherwise. They simply got to work from micro up. That's all they know. But in fact, it's possible to work from macro down. Work at macro itself, and I want to show quickly the basics of that. So if you start with two incontrovertible macroeconomic definitions, the employment rate and the wages share of GDP, apply simple rules of calculus, so you then talk in terms of percentage rates of change, and then the product of the result of two is that's basically the product rule. This is the quotient rule. What you get out of it, you can simply take those definitions and make them into dynamic statements. So the first definition gives you the wages share of output will rise if wages grow faster than GDP, which is obvious. And the same for employment. The employment rate will rise if the growth of the workforce exceeds the growth of the population. So there you have a set of definitions, which are not yet a model. But it's quite simple to say, well, let's just bring in a few simplifying assumptions, and genuine ones in this case. First one we do is we take that there's an output to employment ratio, which is fair enough, and that there's a capital to output ratio, all quite true. Then convert them into differential equations. So I've now got the differential equation statement of those terms, and I'm then going to make some assumptions. I assume a uniform real wage, full capacity utilization, a constant capital output ratio, an exogenous growth of population, and a labor to output ratio. So those are those assumptions now. So we're now under the field of taking a model, taking a set of incontrovertible definitions and turning them into a model. Now with that, I just do a simple derivation, and this is just running those rules horizontally. So I take the output, the employment rate, separate it into the growth of labour minus the growth of the population, then use that definition to define the labour ratio as output divided by the labour output ratio, and then expand it out. And I've now got I'm assuming in the final section where it turns to red, I'm now bringing in my assumption and going from a definition, which is here, to the beginning of the model, which is here. Now, it's the same thing for the wages share. And it's one of these lucky starts where you start with the wages share and then find that the wages share is equal to the gap between the rate of growth of wages and the growth of labour productivity, where I'll put my assumption in here. So I've only got those two terms to define now. And with the Leontief assumption, the rate of growth of the output is the same as the rate of growth of capital, because there's no variation in the capital output ratio. And in his first pass of this model, Goodwin made the simplifying assumption, and it's obviously simplifying, it's not true, that all profits are invested. Now, if I include depreciation with that definition by Goodwin, then I come out ultimately with an answer for what the rate of growth of the economy is, and there's my term for the rate of growth of the employment ratio. Now, this leaves the wage itself to define, and what Goodwin used was a linear Phillips curve. It's supposed to be non-linear, but again, this is a first order approximation. So I've got the rate of change of wages being a function of the employment rate, and the minus a level at which there's no wage change, multiplied by the slope of that linear function. And once I've done that, I've got a very simple model, and I can then simulate it once I put it in differential equation form, and showing that in my Minsky software, which I'll give for reasons of time. I'll do this later rather than now. I'll just load that model, but I'll come back to showing it later if I need to. I was going to show it now. It's got up there. It doesn't take too long to bring up. So Minsky is a means of stimulating dynamic systems live. You don't have to run the model and see the results as you do in other programs. And you can also see that I'm using Greek characters and things like that, much more like familiar with the way that mathematicians work in doing their modeling rather than the way that the current, oh, pardon me, I pressed on the wrong button there, the way that the system dynamics industry in general behaves. So unfortunately, loading it brings me back. This is a new bug in Word. It brings me back to where I started again. So I just went rapidly past that particular point. Now, Goodwin's model has been criticized for being empirically invalid. However, the author of that paper that criticized it admitted to me very honestly that he made a simple schoolboy error of forgetting to convert from percentages to fractions. So therefore, all the terms in his table in this paper in Harvey 2000 that said that Goodwin didn't work were wrong by a factor of 100. And once that's corrected, you find the Goodwin model is a good first approximation to the actual macrodynamics of OECD nations. Now, to get a good derivation, by the way, don't read Goodwin. He's too hard to understand. He doesn't write all that well. Black does a brilliant job of explaining it. That's the link I'd suggest if you want to take a look at that paper. But that isn't enough. You've got to bring in the role of credit as well. And this brings in another issue, which is what is the role of credit in macroeconomics? Now, again, I want to approach that from the first principles foundation. If you start from the definition, the fundamental aspect of macroeconomics, income is expenditure. What you spend becomes income for somebody else. And I then take that idea and divide the economy into X sectors. And if X was equal to every last entity in the economy, that would capture all of GDP. I'm looking at a high level of aggregation, of course, in a model like this. So what I'm going to show is expenditure on the horizontal row of each table and net income on the vertical. And all rows must sum to zero, because that's income equal to expenditure, and the entire table sums to zero, which is why we work in terms of gross GDP rather than net GDP. And the sum of the diagonal, the negative of the sum of the diagonal is aggregate expenditure. The sum of the off-diagonal elements is aggregate income, and they must be equal. Now let's just look at the simplest case where there's no lending and no banking, and you just have money circulating Milton Friedman style in a fixed economy. Then this is households spending A dollars per year on services and B dollars per year on manufacturing, row sum to zero. So for services on households and manufacturing on the other two, and then you can sum the vertical, and each of these can be different from zero, but the sum is also necessarily equal to zero. Well, you then look at this, and there's your aggregate expenditure as the negative of the diagonal, the sum of the diagonal, and your aggregate income is the sum of the off-diagonal elements. That's the basic logic. Now let's look at the myth that neoclassicals continue believing, even after the Bank of England and the Bundesbank both said it was nonsense, that loanable funds applies, and therefore one non-bank lends to another non-bank through the banking system. So what I have here is I'm now looking at the household sector borrowing credit dollars per year from the services sector, and there's therefore a flow across the income, but that's not an exchange, that's a transfer, and therefore because of this flow, there's D minus credit being spent by services and manufacturing, and still C on households. That can be very different terms to the previous table, by the way. It's just placeholders. Same sort of story applies. You get the overall sum of the table is necessarily zero, but what you find is interest turns up as a new transaction between households and services. So interest is part of aggregate expenditure and aggregate income when you're working in loanable funds. I doubt that neoclassicals realize that, but there's no role for credit. It does cancel out. So in their mental view, you don't need to bring in the credit system. But let's now bring in the real world where banks originate money in debt. And what you therefore have is the bank lends credit dollars per year to households, and the household then spends credit dollars per year on manufacturing. That's the example I'm using here. And all the monetary transactions occurring on the liability and equity accounts. So the short-term equity, the banking sector, and also its liabilities, they are the sum of all the transactions. So you're now including G and H and I of bank spending on the other non-bank sectors. When you do your mathematics of just adding up the negative of the diagonal or the sum of the off-diagonal, you find credit as part of aggregate demand and aggregate income. And that's what's left out by the neoclassicals. It's also left out by Goodwin. I'm happy to discuss why that was the case, by the way. Goodwin told me why I left it out. So credit doesn't cancel out. It is part of macroeconomic demand. And what that means is you've got to add the definition of the debt ratio, private debt. So I differentiate that with respect to time. And I've now got two terms. I've got to have the D hat, which is the rate of growth of the debt ratio. So I now just expand out what that is. I've now got investment minus profits. I've now got them being different. And then do a bit of manipulation, bring over y so I can rearrange terms, and I get 1 over the debt ratio, which is what I'm actually trying to work out. I've got D up here and DR down there. Pardon me, the typescripting error. They'll therefore go through y of k of v, and now the rate of change of, sorry? Hello, sorry. Okay, the rate of growth of the capital is different now because we've got investment turning up, because investment was before all of profits, which is 1 minus omega, which is wages share. Now it's a function. So I've now got to bring in a different definition for the rate of growth of capital, which is also the rate of growth of GDP. And there's my new term, bringing in the debt ratio. So I put that through, and I then have, as well as showing wages as a function of the employment rate, I have investment as a function of the profit rate. That's what's going on there. So what I finally get, and I started literally from definitions, but what I get is Minsky's financial instability hypothesis. That's the differential equation. That's a slight expansion of what all the terms are. Pardon me going so quickly, but I'm aware I may have been slowing you down by being a late arrival. So this is now the dynamics. So we saw the other dynamics a moment ago of the model without the low level of debt in it. So by bringing in the level of debt, you start seeing much more curious dynamics. And you can see that the cycles in employment versus wages are falling over time, which you might call the great moderation. Notice that wages are falling as the debt ratio rises, which is the increase in inequality we've seen. And then if I let this model run for long enough, we'll get to the stage where there's a big enough debt level that the interest payments, the decline in interest payments doesn't work to reduce the level of activity, and you finally get the stage where the financial sector takes over and the economy crashes. So that is how to do macroeconomics from definitions alone. And what you get is emergence capital. This is exactly what Anderson was talking about. There are emergent properties at the higher level that you can't derive from the lower. So the emergent property here is the intermittent transition to turbulence in dissipative dynamic systems, which is the Pommer-Maniville route to chaos, which is part of the behavioral Lorenz equations. And that rising level of debt and a falling workers' share of income is an insight you certainly wasn't built into the model, but you can't get out of the definitions either. It's something which emerges from the
Can you slow down, please? This is a Russian language is a little bit longer than English, so.
So My apologies. I'm always conscious I speak too quickly, even for my English language listeners, so I will slow down a bit. Okay, so what I have shown is that you can actually derive the fundamental behavior of the macroeconomy from macroeconomic definitions. And what you find is something which was completely mysterious to the neoclassicals. What they thought was a result of their good policy, what they called the Great Moderation, where there were falling cycles in employment and economic growth, is actually a sign of approaching chaos. It wasn't their good management at all. And you would then get principles that tell you should manage the macroeconomy, including the level of private debt. You can't let it get too high, which has happened under the neoclassicals. So then that's the very basic model. What I've done in this model here, and I won't bring that one up on screen, but you can see the overall dynamics. I've simply brought in the definition of the price level. So I've got a single commodity price level here, and what you can see is the behavior even more like what we've seen in the real world, and that is that the periods of instability and disappear and come back again. There are elements to the behavior of this model which, if the neoclassicals saw it in isolation, like for example this period here, as you can see there's suddenly no instability in the profit rate, they would think they've reached equilibrium. In fact, it's a moment before the economy collapses. Now, you can stabilize it, bringing in government spending. That's another factor I haven't included in the models here. But this is a far more fruitful way to do macroeconomics than the way that the neoclassicals behave. And the fundamental idea of this is that the structure of the economy explains its behavior. The neoclassicals have built enormously elaborate mathematical models of simple behavior of prophetic behavior by individuals. Individuals can predict the future, and that's become essential because they can't, their models don't work in terms of the market itself reaching equilibrium. They have to have gods in the models to reach that result. They turn each individual human into God and then say, this is how God behaves in the economy. It's simply a waste of time. Their whole area is a waste of time. So they've done all this stuff because of their own logical failures. And that's showing, again, they have the wrong foundations for macroeconomics. So what we need to do is bring in the correct foundations, and we can start from macroeconomics itself. But there's one more essential element of this. And given how fast I have spoken beforehand, I will only do part of this and I will do it more slowly. I'll leave the other part for people to take a look at later if they're interested. And that is, we have to include the role of energy, because what is left out of the neoclassical way of thinking of the economy, and has also been left out of the post-Keynesian school that I'm part of, is the role of energy. And nothing can be done without energy. I have a little saying, labor without energy is a corpse. Capital without energy is a sculpture. To activate both of them, you must have energy inputs, and then that explains a larger part of how the economy actually behaves. But it also means we have to include energy in our thinking. So what I've got here is showing output in, as we normally use it, Y, which stands for a number of commodities per year. We might call them widgets per year, can be seen in terms of energy per year divided by the energy content of each widget. And you then have a ratio between the amount of energy used by machines and the amount of energy used by human labor.
Стив, извините, время ваше заканчивается.
Steve, we're so sorry, your time is up.
Okay, that's fine. I'll leave it at that point. My apology for being both late and too fast. I'll hand over.
А выводы, может быть, вы к выводам перейдете?
Maybe you will jump to conclusions from your talk and just do the conclusion bit.
Okay, I'll do that very quickly. Just a moment again. I'll just have to, I'm going to scroll very quickly, just that's the fastest way to get there. A fair bit of mathematics rolled in the overall presentation, a lot of material. So I'll get to the end here. And that is, why did economics become so bad? Why has it missed all this realism? Who do you blame for the fact that economics is non-monetary, falsely equilibrium in a non-equilibrium system and not biophysically realistic. Now, you could blame William Nordhaus, and I do blame William Nordhaus, or Robert Solow, or Ramsey, and so on. But I actually take it right back to say the person we should be blaming is Adam Smith. Because if you read Adam Smith, you see he starts The Wealth of Nations with a statement about the annual labor of every country is the fund that enables it to consume. But if you look at a predecessor of his, Cantillon by saying land is the source of value. And what he was really talking about is free energy. And that's correct. This is the physiocrats. So they were biophysically correct and Smith was wrong. And because of Smith, we've spent 250 years arguing over whether labor or capital is the source of value, when in fact energy is. And that was a waste of time, which we should never have got involved in. Thank you.